we watch and are concerned about. It's just the governments are becoming larger and larger part of the economy. And I can speak Canadian perspective. I mean, in 2020, 52.5% of our GDP was eaten up by, a government level, whether the federal level or whether it's provincial or state level or municipal. Over half the economy now is subsumed by the government. And so, to think that you can actually grow economies and have dynamic economies with that type of government presence, I think is naive. So the government's become too large, too intrusive.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. The market rally that began back in October was in danger of stalling out just a week ago, but then the S&P caught fire. Are the bulls back in control, or could 2023 be another down year? To discuss, we welcome financial advisor Jonathan Wellum to the program. He's founder and CEO of Rocklinc Investment Partners, the financial advisory firm I'm pleased to announce has just been selected as Wealthion's first endorsed financial advisor in Canada. Jonathan, thanks so much for joining us today. I'm really pleased to have you and your team on board.
It's wonderful to be with you. We're excited with the new relationship and looking forward to working with you and many of the clients.
Okay, great. Well, look, Jonathan, I've got a lot of questions here for you. Love to get your macro thoughts, your thoughts on the market. Love to get your sort of ex-US view of the market situation as well. And I'm sure our Canadian viewers here are excited to sort of, see us take you for a test drive here. And who knows, maybe they might want to schedule one of those free consultations with you. We'll talk at the end of the video how interested folks can do that. But to get things started, Jonathan, let me just kick things off with a question I ask everybody who comes on this program first. What's your current assessment of the global economy and financial markets?
Yeah, we're very, very careful, very cautious, very concerned about the overall financial picture. And what that means is that we see that the challenges of the increasing interest rates over the last year, as that continues to slow down the economies, and as we see the just increasing government involvement in the economies, we are cautious. So we're looking at the economies to go along at a slower pace, if anything, and are would not be surprised if we slipped into a recession later this year. And so in terms of our positioning and how we're approaching that, we're being very careful in terms of the businesses we're buying, and also keeping a little powder dry so that we can take advantage of volatility as it comes up in the market. The recent challenges in the US and also in Europe and Switzerland in particular, the banking problems, I think, are indicative of some of the challenges that are going to remain with us for some time. We don't see those disappearing anytime soon.
All right. You mentioned there that it's sort of a time for defense, or at least a time for caution, and create some liquidity so that you can take advantage of opportunities that volatility may surface as time goes on. We've had a number of experts on this program of late talk about how they see the potential for markets that kind of go nowhere when you look at their starting point and the ending point over the next couple of years. Lynn Alden used the term potential lost decade yesterday. And in that type of, it doesn't mean the market just flatlines, right? It just means that it bounces around, but over the arc of time, it kind of ends up where it started. And so in that environment, kind of just the passive buy and hold strategy that worked so well for the past decade, probably not going to do so well. And a much more sort of active approach of looking at the cycles when things get overbought, oversold, et cetera, is probably much better suited to that type of environment. Would you agree with that?
Partially, I would. I mean, I think that just buying a bundle of stocks or an index and sitting back and waiting for it to go up probably will be more challenging in the next number of years. And that's because, as I think everybody knows, that there's been such an aggressive amount of spending and deficits and money expansion over the last number of years, and also the low interest rates for over a decade that really repriced assets much more favorably. So we had higher valuations on assets. As that adjustment has to inevitably take place to maybe some lower valuations, a little more trying times, increasing interest rates, cost of capital has become higher, and so on, then I think just sitting back and just buying a bundle and sitting on it for an extended period will be more challenging. What we do, though, I mean, we're value investors and we are longer term investors, and we like to own things for extended periods, providing they remain great businesses and trading at good prices. I do think that a couple of things, there will be opportunities to do a little bit more trading. And I'm not talking about, in and out of stocks every couple of months, but just increasing the turnover rate from what might be 15%, maybe up to 25%, taking advantage of the volatility, and also really focusing on certain businesses and sectors that will be more favorably disposed in this current environment. So that means staying out of some sectors and not worrying about being overly diversified to the point where you have to be in every area. So we're trying to actually focus in on areas that we think will be less impacted by a slower growing economy, potentially stagflation, and yet can continue to grow because they have good secular growth trends behind those businesses, and the really good managements that are running them and are seizing on opportunities along the way.
Okay. I was going to kind of save this for later in the conversation and maybe we'll revisit it, but since you kind of cracked the door open there. So what are some of the criteria that you look at when trying to identify those types of companies? So you mentioned good management, that's one of them. But when you talk about sectors or companies that you think could do well, given this kind of potentially stagflationary environment that you see ahead, like what indicators are you looking at, or what company attributes are you looking for?
Yeah, I mean, we're looking at companies. Clearly, the management team has to be exceptional. So you're going to look at the quality management team, their ability to deploy capital. But we're going to look at businesses that generate significant amount of free cash flow. We really love cash flow, and that doesn't surprise, I think, anybody. If you're a longer term investor, you're looking at the ability to companies to generate the free cash flow. That's how you're going to value the companies on their ability to compound that. Looking at industry sectors where they can grow at multiples of the overall economy. So I think some areas in technology we have exposure to, some areas also in some of the infrastructure assets where there's a lot of capital going into certain areas that will favorably dispose those businesses. And we also, I've listened to a number of your guests over the last number of months. And I think the precious metals, we have a number of investments in the precious metal space. Especially we like the royalty companies. We're not big on speculating on mining businesses per se, but the royalty companies, and a lot of them are well positioned. Some not just in gold and silver, but also some of the base metals, copper, nickel, potash. Some of these areas which I think will continue to do well. And again, if you're thinking of electrification and this whole energy transition that's taking place, I think there's some good opportunities in those areas, even in an environment where there's not a lot of growth and we're sort of struggling from an economic perspective as governments have to eventually rein in some of their spending.
All right, that's actually a great list of criteria. Thank you. It all makes sense. One thing, just for folks that maybe don't understand exactly what you mean by royalties, royalty companies. Can you just explain those for a moment? Because those aren't companies that are taking on the expense and the risk of trying to discover precious metals or dig them out of the ground. They're basically setting up, in their case, hopefully, an arbitrage where they're basically buying ounces, or they're buying ore at a certain price, and then they're selling it at market price, and they're hoping that there's going to be a positive difference for them to capture there, correct?
Exactly. These are amazing businesses if they're well run. I mean, back in my previous career, before I started Rocklinc back in 2010, I was with a large mutual fund company. I was the CEO of AIC funds. We were the largest investors in the 1990s of Franco-Nevada. And before it was bought out by Newmont. And so I knew one of the founders, well, I knew both of the founders, Seymour Schulich and Pierre Lassonde, quite well. And I fell in love with these business models because they're really investment bankers with a perpetual cash flow stream. So you're a miner and you need capital. What do? You can go to the bank, course, the bank never gives you money unless you don't need it. And then you can go to the capital markets, but you've got to issue stock, which is permanent dilution, or you can go to a royalty company who will give you capital. And in return, and they'll do their due diligence. This is why we like the royalty companies also. They'll put their geologists there. They'll look at viable projects with substantial upside and located in great spots where there's been good research to delineate a nice find. Then they'll put capital on the table. And in return, they get a piece of the production in perpetuity. And that could be through a smeltering return, so a volume amount of royalty, or it could be through the profit. Or it could be a stream where they're going to get a piece of the production and they pay a small amount and they're able to sell it at the full price. The long and short of it is they're getting a cash flow stream off of that production. And once they put the first dollar down, they don't have to put another dollar in. And then so all of the production for the next 5, 10, 15, 20, it could go on for 30 or 40 years. Will go to them. The other thing we like about the royalty is it's a property right. So it goes on the property, and if the miner goes broke or goes out of business, has a problem, then someone else comes along to that property, providing it's a good property, they have to pick up and honor that royalty. And so these are great cash flow vehicles. The other benefit of a royalty company is they can have 20, 30, 40. In the case of Franco-Nevada, they've got over a couple hundred royalties. So you get a built-in diversification also. You don't get as many specific political risk in one country. You don't get just one mine risk. It's spread out. So when inevitably you're going to have issues with any particular mine at different times or different governments, then you've got a nice diversified cash flow stream. So you take a company like Franco-Nevada, it's like $30 billion market cap and more, and they might have 30 key employees. I mean, there's nothing like it in terms of the perpetual cash flow streams. And if you believe that these underlying commodities, gold, silver, oil, copper, nickel, the different base metals that they have exposure to are going to go up over time, if there's inflation, if there's increasing demand, then they get all of that participation of the upside. And the optionality is just beautiful. So we love those businesses, and we've got a number of them in the portfolios, and they've done well. They're great cash flow companies.
So that's fantastic and fascinating. I did not know the property element of it, where you basically said it's the claim is basically part of the property. So if the property gets passed on in bankruptcy or whatnot, the new owner still has to honor the royalty. And just so I understand, so they put their money down once to set up the royalty or to fund the company that's asking for capital in exchange for the royalty agreement. The royalty agreement is basically like I don't call it perpetual, but it's a very long-lived, it's like a long-lived futures contract, right? Where it just basically says, we have the right to buy from you at X price for the next 20 years, let's say.
Yes, and that would be a streaming arrangement. That's right. So what had happened in a streaming arrangement, they would get for every ounce that comes out, a certain percentage of the ounces. So typically, if for example, if you were producing 100,000 ounces of silver, the streaming arrangement might allow you to get 10% of that. So say 10,000 of those ounces. And you could buy those at fixed costs, and it's usually way below the spot price. So say in the case of silver, you could buy it at $5, and then you could resell it. The company would give it to you at $5, and you could resell it at the market price, $22 today or something like that. And then you're going to scoop the margin. Those would be a streaming contract. There's also the royalty ones where it's just off of they call it net smeltering return, and you get it off of the volume that's going through the miner, the amount that they're actually mining out of the mine. So that would be more of a volume transaction. It wouldn't be based necessarily just on the ounces per se, but it would be on the volume of production and or profitability. But if you see, the thing is the spread and the actual margin that miners walk away with over time is not that large. If you can capture 3-4% of that right off the top as a royalty company, you're really taking, in many cases, maybe 20% of the equity value of that property. I mean, it's a great piece because it's all guaranteed. If inflation costs go up, if oil costs go up, if labor costs go up and so forth, it doesn't change the economics of the royalty company. All of that comes out of the bottom line of the miner. Now, where that could impact is maybe they shut down the mine and they don't produce, then that would fall back on the royalty company. But the royalty companies, if they're smart, and the ones that we own, like a Franco and Wheaton Precious Metals, Sandstorm, Cisco, these are very well-run companies, and they've only largely, they don't make too many mistakes, and they largely are supporting properties that have fantastic economics and are certainly not going to get knocked off quickly just because of inflation. These are properties that are very important to the global economy. They're producing very important base metals that are necessary, and the economics make a lot of sense. So the mining company might get pinched, but the royalty companies can do very, very well. And we've seen that over the last, if you look at the charts of the mining companies versus the royalty companies over the last 10, 12 years, it's pretty staggering when you consider the returns from the royalty companies versus the miners. And I'm talking here the major miners, or the sort of the mid-tier and up, not the more speculative ones.
Okay. Again, super interesting. And I'm just peeling away here because I want to make sure the audience is fully understanding here. So you talked basically about royalties and then streaming relationships. And I want to make sure I'm getting this right. The royalty relationship sounds like they fund the company and that gives them a claim of a certain percentage of volume going forward. Okay. So they put out money at time one, and then they just collect ore, or at least the right to purchase the ore for whatever the term of the royalty contract is. That differs then from a streaming contract, which is more, maybe to my example, like a futures contract, where it just says, hey, you have the right to purchase up to X amount for us, in any given period at set price X. You're nodding as I'm saying this, so hopefully I got both those right. And in both cases, as you said earlier, part of the beauty of this is for every dollar that the metal price goes up after that is 100% gross margin.
Exactly. Yeah, exactly. And remember, the companies are now hybrids, because in the early days when Franco-Nevada was really one of the only main companies in this space back in the 90s, and they also had Euro-Nevada, they were largely all royalty companies, and they would get their monies off of what they called the net smeltering returns or net profit interest. Wheaton Precious Metals, which was Silver Wheaton and then converted to Wheaton Precious Metals later, but in their early days, they were really one of the first streamers, which gets into your contract, where they could buy a certain amount of production at a fixed cost, and then they could sell it into the market at the spot price, whatever they wanted to in the market. So they get all the upside. So those streaming, that was an evolution in the financing of the mining businesses. And what you find now is you've got a combination in those companies. Some of them have, they'll have royalty streams and streaming contracts in the same company. And largely, I think that becomes an issue of negotiation with the different mining companies as they're negotiating for the upfront capital. And but what's also interesting too that we like is that they typically will value the amount of cash that they're going to put into the business, and they'll do all of their projections on internal rates of return and how much cash flow they're going to get and so forth, and what's the payback period. And typically those are maybe IRRs, or internal rates of return, of maybe 5% or so in this market. But that assumes stagnant prices. If, as you pointed out, if the gold price is going up, the silver price is going up, they get all that upside. And so all of a sudden, those IRRs, internal rates of return, can go from 5% to 8%, 10%, 15%, and up substantially. The other thing that is very important is they typically will put that royalty right or streaming right on a large piece of property that is much larger than the existing mine that they're aware of. And so what happens is through more development of that same property, then they'll find more and more of gold, silver. They'll find the vein will go a lot further, and so as it goes further, it's still in the same property that the royalty company would have their royalty streams on. And so what typically happens is they'll value it maybe on a 15, 20-year payback period. But some of these royalties can go 30, 40 years or more. I mean, some of the contracts that Franco-Nevada is, getting cash flow on now, those were solidified back in the late 80s and early 90s, and they're still doing well because the companies that continue to grow and develop the properties, and as they develop the properties, they find more and more gold, and they also fall under those royalty regime and that royalty contract. So there can be a lot of optionality, both through the expansion of the mine and expansion of the project, and also in the increasing price of the commodity. And so we think if you believe sort of an inflationary kind of environment, these can be great businesses to own, really nice cash flow vehicles.
Yeah, it sounds like it. And I'm sorry to continue to geek out here, but this is so interesting. So you mentioned that the royalty is set for a period of time. And again, let's just use 20 years, right? And then you say they put the royalty claim over the biggest parcel they can where the mine is, right? So let's say when they strike the royalty deal initially, you've got a producing mine, and obviously the clock for that mine starts ticking on day one for the 20 years. But let's say 10 years later, they follow the vein and they open up another, extraction operation on the same parcel. It's covered by the royalty, but does the clock for that part not start until they start extracting? So in other words, you're 15 years, 10 years in, 15 years in, you activate another part of the parcel. Do you then have 20 years from then to get the output from that new part?
Yeah, basically, there's not timelines on these. I mean, there could be some remote ones, but the basic gold, silver royalty companies, the Francos, the Wheaton Precious Metals, and so forth, when they put that royalty down on that particular deposit, and then they try to grab as much land around it as possible, so that as the mine develops and expands, those are perpetual. Those are until
perpetual. Oh, that's amazing.
They're until the mine is basically extinguished or the economics of the mines don't work anymore and you stop production. So that's the beautiful thing about it. They go on and they go on and they go on. And as they say, if you just make this simple, say you have a 20-acre piece of property that where you found and you've delineated a large body of gold or silver or some kind of ore body. And that justifies that $50 million royalty. Well, that 10-acre spot, that's great. That's where they're going to develop and they'll work away at it. But the royalty company will try to, instead of just 10 acres, they'll grab 50 acres all around that, right? So that's where you can go as you're developing that 10 acres, almost invariably, because these ore bodies and these gold reserves and so forth, they extend for large periods, in directions they'll continue to extend, they'll continue to develop, right? So as they're developing the mine, they just keep going and going, and then they get into these, the broader area that they didn't anticipate at the outset, and that's what gives them increasing volume for extended periods of time. And this is, very, very profitable. So as I say, some of these mines, like the big Gold Strike mine back down in Nevada, has been going on for decades. And for little bits of money that Franco-Nevada put on that way back in the 80s, they're still making money out of that, probably multiples per year of what they originally put in at that one time. So the economics are fantastic. And that's why, again, that's why we like that business, because they're really investment bankers, and they don't have all of the production risk and all of the things that go along with a mine, which is what we've seen more recently in this market. Is the big pressure on the miners is the escalation of costs. I mean, gold prices are almost $2,000, but the margins are just under such pressure, and we just haven't seen the growth in the stocks of the Barricks and the Newmonts and the Kinrosses and so forth. They've been rather abysmal in terms of performance.
Right. And I was just about to go there, which is the royalties companies and streamers, they don't have that exposure to rising costs. And as rising costs kind of push up the overall costs of the metals themselves, even if the producers' margins are getting squeezed, it's not for the royalty guys. You're just enjoying your pocketed arbitrage on your royalty commitment and what the current prevailing market price is. So it's great. I didn't mean to make this a royalty interview, but I think this has been really useful for people.
And the one thing too is diversification of political risk. And that's something that you always worry about with miners, because they can't take their business elsewhere. I mean, it's in a country. And so we've seen this in Chile, changes in government. We've seen, pressure. The Panama government's gotten aggressive in terms of negotiations. And so as countries become increasingly under economic pressure, they will look for opportunities to extract more in taxes and extract more out of these miners. And so if you're just a mining company, you've got two beautiful projects, but you happen to end up in a couple of countries that need to extract more money out of you in order to pay their taxes and to balance their budgets and look after their citizens in a global environment that's under pressure and seeing all these inflationary pressures, then again they can hammer you and take true equity value right off the top. And so again, while you're in the royalty companies, they'll be less impacted by that, number one. And number two, you're getting in most of these royalty companies hundreds of royalties in multiple jurisdictions. So it gives you that diversification, which I think is really important, because the worst thing you can do is pick a great mine, get the right commodity, but then end up in the wrong country. That's not a pretty picture.
Right. All right. Well, look, folks, I think we've beaten the royalty horse pretty bloody here at this point, but very fascinating. And obviously, if it excites you, dig into it more. All right. Well, look, let me jump here. Well, real quick, as we sort of wrap up on the macro side, what are the trends that you expect are going to have the biggest impact on the markets this year? We've got inflation, we've got high interest rates, we've got what the Fed and the other central banks may do in the future, right? That's always a wild card, what the policy is going to be. We've got the risk of recession with potentially commensurate layoffs. You talked about sort of seeing stagflation going forward. We have a housing market in correction, and I think that's got to be a worry to anybody in Canada, because you have some of the biggest housing bubbles in the world. There's obviously geopolitics and the redrawing of trade. There may be some other things to add to that list, but as you guys are sort of looking at, your macro outlook going forward, what are the big ones that you're keeping in mind as you're trying to determine your portfolio strategy?
Yeah, I think the biggest issue from our perspective is that we've had easy money for a very long period of time, and that has caused asset values to be higher, including, as you point out, in Canada, real estate. We've got some of the most expensive real estate in the world, and it's also created a tremendous amount of indebtedness. And so we've got a massive amount of debt in the world, and as you put interest rates up, I mean, you don't have to be a PhD in economics to realize that your funding costs have gone up substantially. So we're looking at all of that, and we want to be cautious. So I think interest rate changes and just what the implications of that are going to be going forward are a major issue for us. It's raised the cost of capital. It means that a lot of zombie businesses or businesses that had free money are going to have to be more accountable to the capital, and that means prices are probably going to continue to be under pressure in certain industries. That's why we love companies with amazing balance sheets that generate free cash flow. That certainly don't have to be looking to the markets for capital. We cut not all, but we cut virtually all of our bank exposure 5-6 years ago, so long before the recent issue. And so we have in Canada, you have to remember, in Canada, about 25% of our Toronto index, our TSX index up here is banks. But our view, again, in that sector is that, increasing interest rates, the massive indebtedness of the Canadian population, the assets of the banks are the consumer liabilities. And so we've looked at that space and said, we don't want a lot of exposure to that area. We think it's dead money at best, and it could be problematic. That's, again, long before the problems as they've emerged in the US. I think those banking problems and are not going to go away anytime soon. And I go back to the global financial crisis and the European situation. I've been telling friends over there in Europe for some time. Credit Suisse was in horrible shape, and it eventually went down. Deutsche Bank, we've written about it, is probably insolvent. It's just an extension of the German government. And then the French banks, they were a disaster in 2010, 2011, and they did nothing to fix them. So I think this banking situation could, again, it's going to just continue to cause disruptions in the global environment. So this increasing interest rates, the cost of money, some of the pressure that's putting on the financial system, along with inflation, which you're seeing impact earnings. And so as the earnings come along this year, you're going to listen to companies say, yes, they're passing on prices, but there's usually a lag and it's tough. And so again, we're trying to look for businesses that have pricing power, so that as they put the prices up because of inflation, they're caught less in that problem of decreasing earnings. So I think all of those things are coming together just to create challenges in the market, which means, again, why we're cautious and looking to certain industries that, a little more resilient to those challenges and won't be hit as hard in the market. It's been a long time that we've had easy money. And, the increase last year was massive. And that's been a shock to the system. I just don't see that disappearing anytime soon. We want to be careful and take advantage of it. So, as there is volatility and as we see assets being bounced around the marketplace, to us, that's opportunity. Doesn't mean we're running from the markets. It means that we're just being more surgical and more precise in terms of where we're investing.
Great. And again, that's back to that sort of heightened active approach that I was sort of alluding to earlier. So to your points there on rising cost of capital and upwards inflation pressure, obviously we can kind of understand why both of those have moved so quickly in recent years, because it's been all the extraordinary intervention that's gone on and policy shifts. But when you sort of zoom back, right, for the past couple of decades, we enjoyed a declining and then record cheap cost of capital, right, over the past 40 years, as interest rates declined and then basically were held at ZIRP for years in many cases. And inflation, was coming down. It was a highly disinflationary time, right, because of globalization and global labor arbitrage and all that. So I'm curious, do you feel like we have hit a bottom of that trend, and then going forward, so secularly, should we expect over the next couple of decades, higher cost of capital and higher inflation than we have had, right? Is there a trajectory change here, or is this short-lived and you think, okay, and as it seems like many people in the market want to think, oh, the Fed's going to pivot at some point soon and we'll just go right back to the way everything used to be?
Yeah, the concerns that we have are again, as you alluded to some of them there. Some of them are structural. So, okay, you've had globalization, absolutely, and that was a major contributor to dropping the cost of production and manufacturing, labor costs, and so on. So that is reversing, and it appears, as best as we can see, that's going to continue to reverse. I mean, we have a world now where you are, the Russia, China alignment. We'll see what India does and so forth. Those are, I think, contributing to more the continued trend to deglobalize. And to the extent that that continues, then we'll be unraveling some of the benefits that we've seen over the last number of years. Now there'll be other benefits to bring back some of that manufacturing here to North America. There's less labor involvement, so there's more capital intensity. So I think those shifts will eventually we can weather that quite well. But in the interim, I think there's challenges with that structural change that's taking place and the fighting going on in the world currently. The other issue that we watch and are concerned about is just the governments are becoming larger and larger part of the economy. And I can speak Canadian perspective. I mean, in 2020, 52.5% of our GDP was eaten up by a government at whether the federal level or whether it's provincial or state level or municipal. Over half the economy now is subsumed by the government. And so, to think that you can actually grow economies and have dynamic economies with that type of government presence, I think is naive. So the government's become too large, too intrusive. The regulatory regime that we're seeing in Canada in particular, you're seeing it also through the Biden administration, again, is going to cause difficulties in terms of driving growth. So we're looking at all of those and saying that's why we need to really, I think, batten down the hatches and be very careful about where we're investing. To think that we're going to see 3 or 4% growth rates again anytime soon, I think would be naive. It would be great if it happens, but we're certainly not betting on it. I mean, every time you turn around, there's more regulations and governments getting involved. This whole energy transition is inflationary. And so to, go off fossil fuels, and, we know in Canada, we're, one of the largest possessors of reserves, oil and gas reserves. And the government is doing everything it possibly can to hinder, the development of those reserves. And so, to shift to other alternative means, the green energy and so forth is going to be expensive. And so that too, I think, will cause problems. Now, we try to invest in that space. So we've got some renewable energy. We're trying to buy, nickel, copper, get exposure to some of the areas that will benefit. But at the same time, I think it will impede other, areas of growth in the economy. So we're looking at all of those. It's not just one thing. I think, we just aren't seeing the policies that are interested in increasing production. This is one of the problems, I think, with inflation right now. The Fed's objective is to, crush the economy enough to take out inflation. Our view would be, why aren't we focusing on production? Why aren't we making more things, make it easier to put more goods out there, so that money that's chasing the goods is actually chasing more goods. And that would also be a benefit to bringing inflation down. But we just don't see that occurring anywhere in the our Western countries anymore. There's just this government intrusion in every area. So that also just dampens our enthusiasm in terms of just unbridled growth. And it makes us, again, more and more surgical on where we're investing and trying to pick the secular trends that are, somewhat more impervious and, won't be hammered as much by all of these other policies.
Okay, well said. And, high level, you think that will be growth challenged. And so again, you got to really, search surgically, in your words, for the companies that are positioned to outperform versus everybody else. Okay, so now to the meat of the bone, or the meat on the bone, your market outlook. So as you look across sort of the rest of 2023 here, what's your best estimation of what you think the market's likely to do? We've had this sort of tug of war between the bulls and the bears coming into this year, right? We had sort of bounced off the October lows, but the time that you and I are talking here, the S&P is not that much higher than it was at the start of the year, and so it's sort of struggling to find a trajectory here. And who knows, maybe it'll just slop around the rest of the year. But there are people like you that say, hey, inflation or recession looks like it's coming in the second half of the year, and many of them are predicting lower prices ahead. But there are a few that say, no, I think the Fed and the other central banks might finesse this, and the bulls might get a chance to run. So what do you think?
Yeah, we're trying to be, I'm not trying to evade. It's a great question.
Yeah.
We're trying to be somewhat agnostic to that question and focus more on the businesses. So we'd be 75% sort of bottom up and then 25% sort of top down, because you have to, anyone who says they're just totally bottoms up looking at businesses only, I think is a bit naive, because you have to contextualize the business and put them in the broader context. So so to answer your question, more directly, even though we're focusing still more on the bottom up and trying to invest, even if it's a tough environment, hoping that it won't be as tough. I think that, the good news, if you want to put the more favorable side on it, I think, look, we've had interest rates come up quite a bit. It appears that there's going to be a pause here after this. I don't, we've got a contraction in credit. There's a lot of things going on underneath the surface that will, I think, slow down inflation and at least take it down further, not necessarily to 2%, but take it down further, which could give the Fed and the central banks a little more breathing space. I do not think that they want to take out the banking sector and cause problems there. I think that's a bigger issue for them. And so if that's the case, and interest rates don't go up, and even if we get a cut, there's some very well-respected people that I listen to and watch that focus on these things all day long. And they're saying, hey, we could even get a cut or two at the end of this year. Then that could very much so put air and put some wind under the markets, and we could see markets, higher by 5 or 10% by the end of the year. And I think that would be the favorable case.
And I'm sorry to interrupt here. I just want to interject that the market is pricing in rate cuts this year. I'll put up a chart of some of the latest projections there. And we even had, Jeff Gundlach come out the other day, very highly respected guy, who's basically, he is warning of recession. So he's very concerned about a recession that, in his words, he's saying is sort of imminent, meaning like next couple of months. and possibly because of that, but he is predicting the Fed is going to be pivoting and doing at least several rate cuts this year. Who knows? We'll get our popcorn out and we'll wait and see. But
Yeah,
you're
Jeff,
right, that is what the market's currently predicting.
And Jeff Grunlich, I think is he's got as good a handle on this as anybody. He's obviously an exceptional fixed income investor and has got a good window on it. I think what he's promoting there, I think, makes a lot of sense when you're actually looking at the numbers objectively.
Okay. Well, so you know, the canard that I have been saying often is the people, the market's been hoping, all last year, this year, for a Fed pivot. And it seems that the market is dreaming that, okay, when the Fed pivots, we'll go right back to happy days again, right? Where the Fed very well may pivot, but it may pivot because it broke something. You just said the Fed doesn't want to, take the banking system down. We already saw how quickly it reacted to two non-systemic banks in the US, right? So if something bigger happened, yeah, the Fed could be forced to pivot to do that, but that's not necessarily for bullish reasons, right? I mean, I just want to, I'm curious, to get your opinion on this, but does pivot equal good markets, or can pivot, does it totally depend on what the conditions are and the reasons for the pivot are?
Absolutely. I mean, again, I think look, a pivot is going to be helpful. It will give people a little more enthusiasm. We've already seen 10-year rates come down, so that eases a bit of pressure, for the banking sector and so forth, because a lot of that was if they weren't marking the market, but if they had to mark the market, they were sitting on larger losses. Some of those losses have diminished because the rates have come down. See, I think the bigger issue, for us, Adam, is that we now have economies in the West here that are running 120, 130% debt to GDP. Yep. So we have very, very leveraged economies. We have a global economy where it's well over $300 trillion and so forth. I mean, all these numbers are just massive, and they're kind of shocking. And so we've seen debt to GDP go up by 3 times. It used to be 100%. Of debt to GDP, and then when you include all personal debt and so forth in the United States or Canada and corporate debt, it's well above 300% debt to GDP. So we're in highly levered economies, and so that's the concern. So yeah, they pivot. The reason they're pivoting is they can't put their rates up because it'll just take all of the economies down. I mean, if you think about $300 trillion, every 1% increase is $3 trillion of funding costs. And you put interest rates up by 3%, that's like 9 trillion. And basically our global economy is just a little over 90 trillion. That's almost 10% of the global economy. So we're really fully cocked here. And so that's why I think we want to be careful, and a pivot by the Fed doesn't mean the good times roll again. We've already had the good times for the last 40 years in terms of racking up the debt to GDP. And so I think it's going to be a tougher struggle. I would welcome a pivot in one sense, but if we're still running inflation, if we can't get a handle on this inflation, which I think is, again, a lot of it's policy driven too. I mean, it's been driven by bad decisions, both by the Fed and also by governments that are spending money that they shouldn't. And some of that was exacerbated by COVID. Then if we were running inflation, then we could have standards of living drop, and interest rates, even now, as you know, Adam, are still negative when you factor, real interest rates, right? Even though nominal interest rates have gone up, our real interest rates are actually negative still. So that's not a healthy sign. So that's why, again, we want to be cautious, careful, pick off certain industries, look for very well-financed businesses, because we don't think the rip-roaring days, can come back that easily because of the overall indebtedness of the countries. And then if you overlay that on the aging demographics, I mean, as you know, in the United States, we have a similar issue in Canada, maybe not as profound in terms of funding Social Security and sort of these retirement programs. In Canada, we're a little bit better funded. Our Canada Pension Plan, CPP, they've been extracting that out of our pockets for a little more aggressively. But in the U.S., you also know that there's like 9 years left, and that's assuming things are good without some kind of restructuring. And so you've got this aging population all around the world too, and that's not bullish for growth either. So there's all these factors that, again, doesn't doesn't make us negative. It just means that we really want to be sharpen our pencil and be very careful about where we're investing, and as we take a longer term view.
Okay. All right. Well, look, I'm looking at the time. I've got a lot of questions that they're just going to have to wait until the next time you come on, Jonathan. But a few here as we wrap up. Okay, so you just gave out this, challenging or good summation of the challenges that we face going forward, and obviously, your challenge there as a wealth steward for your clients is to try to help navigate the best path possible through all this to protect and grow wealth. I guess two questions. One, is there any just sort of parting counsel that you have to the average prudent investor that's watching this channel and trying to figure out how they're going to protect their destiny going through this type of environment that you just described? Anything that we haven't talked about that you want to provide some counsel on for folks?
I think the thing I'd really want to double and triple underline is that keep a focus on businesses and keep a focus on the actual investments themselves. You can get preoccupied with the macro, and again, you need to know what's going on in the macro, but you can also become debilitated if you just look at the macro and you look at all the problems. I think there are dynamic businesses. Businesses are organic. They're run by sharp people who are constantly making audibles and changes along the way and allocating capital. And so I think, again, having been influenced by a Warren Buffett view of investing and going down to his annual meetings for so many years in the past, I do think that focus on what you can control and what you can understand yourself, which is really more the businesses and the opportunities there. And the world will take care of itself. There's things that we don't control there. And you're much better to be in the game than, when I say in the game, investing prudently and participating in the economy than just sitting on the sidelines. That's a sure recipe for falling behind. And I think there are always opportunities in the market. There's always opportunities. And it's our job really to ferret those out and to look where capital can make money and where, the secular growth trends are. And then keep pressure on governments to behave themselves and hopefully elect governments that are going to be responsible and good stewards of the capital that they're taking from us. And we'll see what happens.
All right, well said. And I do like the underlying message there, which is, look, we all are trying to track the macro situation. It's a big reason why this whole channel exists. People get on every day to see where the macro puck is headed. And it's important we know where it is headed, but we cannot control it, right? We don't have the ability to shape the macro world. But what we can control is what are the things that we put in our own portfolio, right? And like you said, if we, kind of no matter what the weather is out in the ocean, if we put together the right, quality ships with quality captains and whatnot, our ability to do well in calm or rough seas is going to be a lot better if that's where we place our focus. So, all right, I'm going to ask you in just a second where, or I'll share in just a second where the Canadians watching who've been happy to get exposure to you and are interested in having a chat with you and your firm can go. But real quick, I had written down a question here while you were talking that I'd love just to get your answer to, which is, your job is to work with clients and help them, like I said, protect and grow their wealth. What makes a good client for your firm?
Yeah, that's a great question. For us, we like clients that do follow events. So we'd prefer to have clients that are engaged with what's going on in the world. Not the same level we are. That's why they're coming to us. But like asking questions and like looking at the investments that they're in. Educated client. We love that, because we like to talk about the businesses we own and why we own them. We're very transparent. So, we run portfolios that are, 25 to 30 stocks type of thing. And we know why we own each business. And we study those businesses and we try to talk to all the managements of those businesses. And so we love it when our clients follow along. We try to go on the websites, learn more about where you're investing. We're really transparent and they can see exactly what they own. On the other hand, we have many clients who say, look, at you guys are the experts, and we're going off on a cruise, and we're enjoying our retirement, and we trust you, and we don't, that's fine. So we have the cross section, but a lot of times when people come in, we're so passionate about what we're doing. We love the companies that we're investing in, and we tell them about it. And often I'll say, well, get on their website, look at, their investor section. You can pull up their, their webcasts, you can look at their PowerPoint presentations. But so, we just love, again, clients that, understand those issues and are excited about investing, and can follow what we're doing if they so like to do that. And so we really focus on that education side with our clients and working with them so they know exactly where they're invested and why. And then we leave it up to them on how engaged they want to become.
Okay. I imagine that the why is really helpful in the sense that, like, hey, we can't control what happens on a day-to-day basis, right? And so if there's a period of a market, dip or whatever, where the investment isn't going in the desired direction, but the thesis still seems to be intact. Somebody who understands the why gets it. They're not that worried about it because they understand the long-term why, where somebody who doesn't might be calling you and saying, why is the stock down 5%? Do we need to sell, right?
Yeah, that's exactly right. And what happens is, even with the banking crisis over the last couple of weeks in the United States and over in Switzerland, I don't think we had more, and I'll be honest with you, I don't think we had more than maybe 3 or 4 calls where people just sort of asked a few questions, because we've sort of told them, listen, we're very careful. We're taking longer term views. They know that we're being very cautious and still, making money and putting capital to work. And so we don't get a lot of calls like that. And which is nice. At the same time, we love talking to the clients too. But they have a pretty good handle what we're doing and why we're investing in the areas that we're investing in. Which, again, a well-educated client is our best client from that perspective, and that's what we try to do. Yeah, and we can do that, Adam, because we're focused investors. So it's easy to give them a rundown on where we're investing, why we're investing, because we're not everywhere. And I learned a long time ago, the best way to make money is to be in the company and know the best that's closest to you that you understand. And you can look at the world and you can say, well, it's a big world and I need to be at every corner of it. And you don't really. What you need is a handful of great companies run by good people, and buying them at good prices. And you'll do very well over time if you're disciplined.
All right, great. And for a well-educated audience being a good complement for your services, that's a big part of the whole marriage here between Wealthion and Rocklinc in terms of why we have signed this new partnership with your firm, so that we now have a firm in Canada to officially endorse to Canadian people. So folks, if you're watching, if you are Canadian and would like to talk with Jonathan and his team there at Rocklinc, just go fill out the short form at Wealthion.com, and you can set up a free consultation with them. If you're a US viewer and want to talk to any of the other financial advisors that Wealthion endorses, same thing, just go to that same Wealthion.com URL and you'll set up a free consultation. These free consultations are free. They'll sit down, they'll talk with you, they'll get a sense of your personal background, they'll tell you, what their best advice is. And you can either choose to continue talking with them, or you can take that information and just go implement it yourself, or bring it to your existing financial advisor and discuss it with them. These are free. There is no commitment to work with these guys. It's just done as a public service. All right. And then just a reminder for folks, if you did not watch the Wealthion conference from a week and a half ago, it is still available for replay. To find out how to go purchase that, just go to Wealthion.com/conference. And if you've enjoyed getting to meet Jonathan here, excited to see him come back on the program in the future, especially when we bring our other financial advisors in, especially the monthly Ask Anything Q&As. Jonathan will be participating in those going forward. Do me a favor, please support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Jonathan, this has been a great discussion. I've really enjoyed it. Again, really happy to have you join the panoply here of Wealthion advisors and being able to add the Canadian outlook and the ex-US outlook. Really looking forward to having you back on this program again many times in the future.
Thank you very much, Adam. It's a privilege to be here. We're really looking forward to working with you.
Great. Everybody else, thanks so much for watching.